Are commodity ETFs with synthetic replication riskier for investors? Imagine trying to track the price of gold or oil without actually owning any of it. That's what some commodity exchange-traded funds do through synthetic replication. Instead of holding the physical commodity or futures contracts directly, they use complex financial agreements called derivatives. These derivatives are often total return swaps, where a bank or financial institution agrees to pay the ETF the return of the commodity index in exchange for a fee. The main concern with these synthetic commodity ETFs is counterparty risk. If the bank or institution that provides the swap faces financial trouble or defaults, the ETF might not get the payments it expects. That means investors could lose part or all of their investment, even if the commodity's price stays steady or rises. This risk isn't present in physically backed ETFs, which actually own the commodities or futures contracts. Another point is that synthetic ETFs don't own the actual commodities. Instead, they relying on contractual agreements to mimic the performance. So, your exposure depends on the creditworthiness of the counterparty, not on holding the physical asset. This can make the investment more complex and harder to understand. The derivative structures involved are often over-the-counter contracts, which are less transparent than holding physical commodities or futures traded on exchanges. Synthetic replication can be more cost-effective and easier to manage, especially for broad indices that include many commodities or when physical storage is difficult or expensive. These ETFs can track the index more closely and sometimes offer tax advantages. To reduce the risk of counterparty failure, many synthetic ETFs use collateral arrangements. The counterparty posts assets to secure the swap, and the quality and liquidity of this collateral are important factors in the overall risk profile. In the case of single commodities like gold or silver, physical ETFs are common since storing and insuring these assets is straightforward. But for diversified commodity baskets or indices based on futures, synthetic ETFs are often used because managing all the futures contracts physically would be costly and complicated. So, when comparing the two, synthetic commodity ETFs do carry higher risks mainly because of the reliance on financial agreements and the potential for counterparty failure. However, they also offer benefits like lower costs and easier access to certain markets. Investors should think about their comfort with these risks and whether they prefer direct ownership or are okay with the added complexity of synthetic replication.